Silicon Valley Bank collapsed on Friday.
The second biggest bank collapse in U.S. history.
It is the epicenter of tech startups, venture
Collapse
capital.
of Silicon Valley Bank is causing shockwaves across the entire business world.
To Silicon Valley Bank.
Hi guys, welcome to the channel Talk of the Week. On the 10th of March, America's second biggest bank collapse happened after Washington Mutual in 2008. Yes, the bank was Washington Mutual and not Lehman Brothers Bank. Lehman Brothers were a financial institute. Though this was not the only bank collapse on the 10th of March. Another bank also collapsed on that day, Silvergate Capital Corp. But why SVB held all the headlines though two banks collapsed? Because the amount it was dealing with was huge. It had an estimated value of $209 billion approximately. Comparing it with the Washington Mutual Bank, which was estimated at $307 billion on a valuation approximately. After its collapse, the government intervened into the situation like it is happening now. President Joe Biden had said,
"On Friday, the government regulator in charge, the fdic, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action."
If we compare its size with India's biggest bank in terms of evaluation, HDFC Bank's March 2023 market capital was stated at $117 billion approximately, giving it the #1 position in India, and Silicon Valley Bank with a market cap of $209 billion was placed 18th in the list according to Forbes magazine in the USA. The bank was founded in 1983 and was one of the oldest banks in the history of the US, so clearly the question was not the credibility or trust issue for the customers. Then what happened? How did it fail so abruptly? What factors were responsible for its collapse? The bank was mainly associated with tech startups, ventures capitalists, HNIS, and tech firms. Almost every startup in Silicon Valley was associated with them. Other countries like the UK, Israel, European Union, startups in Bull have started precautionary plans to deal with the current situation. Though we have several points or practices escalated the collapse, we have pointed out 4 of them that worked as a catalyst. Reasons for Silicon Valley Bank collapse. 1. A piece of news that forced other depositors to withdraw their money, which results in an imbalance in the chart. 2. Inflation. Russia-Ukraine war led to a rise in prices of crude oil and change in interest rate in post-pandemic recovery, which had a huge difference. 3. Selling government mortgage bonds and securities before their maturity period, which led to huge loss. Chapter 1. News that forced other depositors to withdraw their money. On March 8th, it was reported that a fund managed by the prominent venture capitalist Peter Thiel requested to withdraw funds from the bank. This news quickly spread and caused other people who had their money in the same bank to also want to take their money out. This created a situation where many investors rushed to the bank to withdraw their money, which is called a bank run. However, the bank issued a statement on the same day explaining that they sold government bonds to increase their money and were also getting money from big global investors. The bank said there was no need to worry, but people who had their money in the bank were still concerned. But that wasn't enough. Within the span of 2 days, the bank collapsed. Chapter 2. Inflation by Russia-Ukraine war and post-pandemic effect. Rising energy crisis, crude oil prices were on a high after the pandemic, and the Russia-Ukraine war added a bit of spice to the situation. The inflation rate in the US was just 0.8% before the start of the pandemic, and the banks were giving home loans and car loans at a lower interest rate, and people were happy about it. But after the pandemic, the inflation rates jumped to 2.5%, which wasn't that triggering, or we say somewhat manageable to an extent. But the real horror started after the Russia-Ukraine war. Distillation products, fertilizers, iron and steel, energy crisis, and crude oil prices spiked up, resulting in an increase in inflation, which leads to a rise in interest rates.
Stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated.
Federal Reserve Chair Jerome Powell told the Senate Banking Committee Tuesday that the Fed could raise rates higher and faster than planned.
Instead of going down like it was during the pandemic to help the economy grow, the Fed is raising rates.
The Federal Reserve is expected to raise interest rates to combat stubbornly high inflation.
This morning, Federal Reserve Chair Jerome Powell signaling more interest rates hikes are coming this year. year, and they could come at a faster pace and hit a higher peak.
If a totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Let's just understand this by an example. In the USA, Federal Reserve Bank lend money to other banks and charge them extra money for it, which is called the repo rate. These banks then use that money to give loans to people who want to buy a house or a car. To make sure they can pay back the loan, the banks must deposit things like government bonds and treasury bills as security. For example, if Bank of America deposits securities to the Federal Reserve and get a loan at a 6.15% interest rate, Bank of America then uses that money to give civilians a home loan of $80,000 with an interest rate of 8.15%. The 2% difference in interest rates is how Bank of America makes a profit. If the Federal Reserve raises its interest rate from 6.15% to 6.25%, Bank of America will also have to raise the home loan interest rate from 8.15% to 8.35% to make a profit. This affects people or civilians a lot. For instance, if a civilian has a home loan of $300,000 and the interest rate goes up, he may have to pay $392 more every month to repay his loan. This means he has less money to spend on other things like going to the movies or eating out. It also means that businesses may have to lower their prices to keep people buying their products. And in this case, the business owners seek help from the bank and withdraw their money from the bank to cover their losses, which means when a lot of people go to banks to seek help and to recover from the loss after a drop in prices to make it affordable for the people and keep their businesses running, the bank suffers. Their balance sheet starts to imbalance. For example, most of the bank does circulation from the money of their depositor and creditors. This is how the Federal Reserve controls inflation by changing interest rates. Chapter 3. Selling government's mortgage bonds and securities before the maturity period leads to huge losses. Now, as you guys know, the imbalance is created in the cash flow in the bank and become tough to run its structure. The bank, to cover its loss or imbalance, sells its securities, which it had deposited in terms of mortgage bonds and treasury bonds, which was supposed to give low interest with steady interest to the bank. But the problem that comes here is that if the bank decided to take out money before the period of maturities of these securities, the federal bank then charges high penalties and high interest, and the bank suffers another loss. In the case of Silicon Valley Bank, when the inflation increases to 9.1% after the Russian-Ukraine war, the bank asked to withdraw their securities from the Federal Reserve Bank, and SVB invested an estimated amount of $91 billion in securities. To understand the difference between the two types of securities, we need to know what the managers want to do with them. For held-to-maturity securities, the managers want to keep them until they reach a certain date. For available-for-sale securities, the managers want to keep them for a while but can sell them whenever they choose. Even though managers can sell held-to-maturity securities before their maturity date, it can be expensive to do so. Here's the chart that shows the losses it suffers. As you can see in the chart, SVB put a lot of money into long-term mortgage investments that would not be done for more than 10 years. This caused a problem because the money they did put in did not match up with the money they had available. The chart shows that they had $91 billion in investments they wanted to keep until the maturity date, and only $26.1 billion they could sell whenever they wanted. Out of the $91 billion, $80 billion was invested in mortgage securities that were not easy to sell. This mismatch had put the bank under a heavy load that it could not recover from. Why the local media and agencies like Hindenburg failed to recognize this incident? Is SVB's collapse could be prevented? Could the banking experts in the US prevent this massive collapse? Yes, they could. After when the world was recovering from the COVID-19, the Federal Reserve Bank increased the interest rates to 2.5%, to which the SVB Bank sold some of its securities to pay off their depositors. And instead of rising the inflation, they kept on giving loans and offer to the startups at 2.23% of interest, which was too low as the recovery point of view, though 2.33% doesn't seem to be too bad if a company with $100 million of assets decides to open an SVB bank with 2.23% of interest rate. The value will be $2.3 million, and that's only one company's valuation. So the point comes that when all these things were happening, few of the banking shellhead had point out this error of inflation going up, but still SVB providing offers at low interest rates. No one stepped in, not even the Hindenburg research. Instead of preventing the great loss, they were busy covering the Adani, which was an idiotic choice of subject. All in all, the SVB's collapse happened because of their poor regulatory policies and improper judgments of cash flow. So that was it from our side. If you want to know in detail how it could affect your daily life or to prevent its impact on daily life, please comment below and we'll make a separate video on it. Thank you. Please like, share, and subscribe. We'll see you in the next effect.